Welcome, everyone, to Election 2024, Policy Implications for the Private Market Ecosystem. Thanks so much for joining us today. We really appreciate your time and engagement. Well, as everyone knows, policy is becoming an increasingly large part of the private capital infrastructure. It affects how founders and fund managers raise capital, what they can invest in, and how they build innovative technologies, and how they navigate an evolving tax system. Policy can bind growth or can unleash it. And obviously, our goal is to support the innovation ecosystem as best we can, and shaping and engaging in policy is increasingly part of that. So we've got a recent election that will have implications on that policy agenda, and those implications will matter to the innovation ecosystem. So today we're going to talk a little bit about that changing landscape and what that means for governing dynamics, and then dive into issues around tax policy, capital markets regulation, crypto, antitrust, AI, and then audience Q&A. Given the breadth of topics, this will provide more of a context on the broader landscape and how to think about navigating it and what it means for you all. So with that, why don't we dive in? I'm joined by my colleague, Holly Hiles-Pandel, Senior Counsel for Carta's Policy Team. Her background is formerly working at the SEC as Head of Intergovernment Affairs and Legislative Affairs, and prior to that, serving as Senior Staff for the Financial Services Committee. So Holly, the election has really shifted power in Washington, D.C. Can you walk us through the results and what it means for governing?
So it will come as no surprise that former President Trump was elected to a second term, and he will have a Republican Senate and Congress to help advance his agenda, albeit with very small margins. As you mentioned, this is going to bring about a dramatic shift in DC, both with respect to personnel and on the policy front. With Republicans in control of Congress, Trump's going to have wide leeway to implement his agenda. But these margins are very slim, and there's still even a few outstanding House races at this point. The margin in the House could be as small as two seats. What this means is policymaking is going to be hard. It's going to require bipartisan support because you do need 60 votes in the Senate to advance most policies. The area where there's an exception is when it comes to tax and spending bills. So with this Republican trifecta, you can unlock a tool called budget reconciliation, where you only need a simple majority to pass tax and spending measures, which is a great seg to tax reform because that is going to dominate the debate next Congress. Care to elaborate on that?
Of course. As you mentioned, tax policy is going to happen. And the reason is because the Tax Cuts and Jobs Act, large portions of it are going to expire. So what does that really mean? Well, at the end of 2025, $4+ trillion in tax increases will go into effect if Congress doesn't act. And those tax increases will affect approximately 62% of Americans. So policymakers aren't going to go home until they address tax reform. And to Holly, to your point, they've got this tool in a unified government called budget reconciliation, which allows a simple majority vote on tax and spending bills. This means tax will happen with Republican-only votes. The question is, what does tax reform look like? And it's our theory of the case that this will start with the big ticket items, corporate rate, personal rate, SALT, but it's not going to end there. It will quickly expand to encapsulate much more of the tax code, including aspects that matter to the innovation economy. That's R&D treatment, that's qualified small business stock, that's carried interest. And all of that's going to affect not only how you operate, how you invest, how you build, but what you can take home at the end of it all. So tax is going to be the focal point of policymakers, and it's really going to matter to this ecosystem.
Let's zoom in on a couple of those issues that you mentioned. I know we always get the question, what's going to happen to carried interest? But there are a number of policy areas that are going to matter to the innovation economy that aren't necessarily going to dominate the headlines. Can you walk us through some of those issues?
Yes, I just flagged a few of them, so let me go deeper into those. In many cases, in a Republican unified government, they are going to be more supportive of these policy measures, which I'll go through in a moment. But the reality is they also have to figure out how to pay for these types of tax incentives and tax breaks. And the reason why that matters is because currently, on trend, we are running a budget deficit that is nearly twice our 50-year average. So it's not going to be a blank check. And so even if policymakers do support the underlying policy, the reality is there's going to be a lot of priorities and they're going to have to figure out how to pay for them. And so that's why it's going to be critical that the innovation economy engages to make our case as to why innovators drive productivity, drive job creation, and ultimately not only create a more competitive and innovative America, but they also increase tax receipts over the long term. So what does that really mean? So let's talk through those three issues I just flagged. Research and development. Now, the big issue here is under the TCJA, the Tax Cuts and Jobs Act, they changed how R&D was treated and no longer allowed companies to immediately expense R&D in that year, but having to amortize it out over a 5-year period. And as a result, you saw the tax bills of many of these innovative companies go through the roof. And so we've seen real consensus around the need to address this and allow for that immediate expensing to be restored. The question is, will they have the political will in the next Congress? I believe they will. I think this will get solved. I think what we need to figure out is, will that be a retroactive fix or just going forward? That's where there's still a little ambiguity, but I think this gets addressed at least going forward, ideally retroactive, because it is an incentive that helps not only drive capitalist ecosystem, but helps companies invest in their future. Now, the second big issue that we're always focused on is something called qualified small business stock. Now, this is a provision that drives capital and talent to the startup ecosystem, the riskiest, but in our mind, the most important part of the ecosystem. And it does that by exempting holders of QSBS shares that hold those shares for 5 years from capital gains. And so immediately it's an incredibly good and advantageous tax break for long-term capital, long-term employees holding those shares. Now, this came under fire in 2021, where Congress contemplated curbing it for earners over 400K. I believe most Republicans are supportive of this provision as is. And what we're actually trying to do is expand it and play offense to include more types of entities, increasing the size of businesses that might qualify, and ensuring different types of transactions, SAFE, convertible notes, et cetera, would qualify. Now, in many cases, we're playing offense just so we can keep this defensive perimeter. If we're successful in expanding it, all the better. But I am optimistic that we can keep this at minimum in place as a status quo. But to me, again, this is a situation where if members decide that they want to increase the SALT cap or figure out how to keep the corporate rate here, they're going to be looking for dollars. And it might come from these types of provisions. And that's why we've got to make the case. The third piece that falls into a very similar construct is carried interest. As expected, we get a ton of questions on this, and carried interest deals with the favorable tax treatment applied to carry from funds. Now, this tax treatment allows the manager's carry to be taxed at almost like a long-term capital gains rate, so half of ordinary income. Both sides demagogue this issue almost every election, including President-elect Trump has talked about curtailing this in the past. I believe we are in better shape to keep this as is, but I would note there is a world in which there are adjustments, not only the timeline, which they've done in the past of those holdings that need to qualify in order to qualify for carried interest, or how we think about co-investment to make sure managers have skin in the game on these types of things. And or is there a small but moderate increase in the rate that moves it up above its current long-term cap gains treatment, but still very well below ordinary income in a way that's just about raising revenue? I believe these are still very possible because you're seeing increased populism in the party that's in control right now. But I think it's more likely than not safe. But the bottom line is we're more bullish that we can preserve these, but none of these are safe. And as a result, we're constantly engaging and trying to make the case. So that's what's happening on the tax reform front. But that's not the only thing that's going to be mattering to the innovation ecosystem. The other big shift we're going to see is on the capital markets piece. Holly, we've seen so much focus on Chairman Gensler and the SEC and what that means for private funds and private capital. Can you talk about what a new Trump administration might look like?
So this is going to be a major shift in terms of policy between the Biden administration and the Trump administrations as far as the regulatory state goes. And that's what happens to private market regulation. So private markets are regulated, but they traditionally received a little less scrutiny than their public-facing counterparts. But we saw this posture shift under current SEC Chair Gary Gensler. We saw new focus on enforcement and exam activities for venture capital and private equity funds. And then we saw a rulemaking agenda that, if implemented, would impose a number of new compliance and disclosure obligations on private funds. The biggest example of this would have been the private fund advisor rules, which I know that we've talked about ad nauseum at this point at Carta. And the court has pulled those back, but there were a number of other issues on the agenda or anticipated items that the SEC has not gotten to yet. This would change the compliance obligations around things like outsourcing and custody rules. But there's also implications for how funds and companies raise capital, whether that's changing the accredited investor thresholds or looking at changes to Regulation D, which is the primary means through which capital is raised in the private markets. I think those items go away under the Trump administration, and whomever he picks to serve as SEC chair will probably have a little more of a capital formation focused agenda versus an investor protection agenda.